Hello, welcome back to Mining Network. I'm joined with Bruce McLeod, the President and CEO at Sabina Gold and Silver, and we're here at Beaver Creek in Colorado. Bruce, good to see you.
Peter, thank you for having me on.
No problem. Just for those less familiar, give a brief overview of the company.
Sure. Sabina is a advanced stage developer that is currently in construction of our Back River Gold District and more specifically the Goose Mine in southwestern Nunavut. Mm-hmm. These are very high-grade deposits, amongst the highest grade undeveloped open pits in the world at over 6 grams. We have been exploring this property and developing it since 2009. We just recently made a formal construction decision, and we've grown the resource from our acquisition a little over 2.2 million ounces in all categories to today in measured, indicated, and inferred about 9.2 million ounces at over 6 grams. So I've been through the process of technical studies, feasibilities, resource reserves, permitting, building our infrastructure and logistics, which is very important for remote projects, and now I'm constructing.
Awesome. Just remind people of the capital structure at the moment before we go into the actual deposit.
530 million shares issued and outstanding, trade on the Toronto Stock Exchange and also on the OTCQX exchange in the US.
Brilliant. Okay, so I just want to, before we go into the economics and sort of the production timeline, etc., just remind people actually of the scale of this. Obviously you're talking about 6 grams of a ton, around 9 million ounces. How much of that is actually in the reserve category and is mineable? And can you just talk to us a bit about the geology of this deposit?
It's a banded iron formation, and amongst the largest banded iron, certainly in the top 10 of banded iron formations in the world, actually I think in the top 5 or 6 now. Banded iron formations tend to be very consistent deposits, deep seated structures. The granddaddy of them all was the lead mine of Homestakes in South Dakota, but I think the one that is probably a closer comparison to Back River is what is now Newmont's Musselwhite mine, that was originally a Placer Dome mine and then Goldcorp before Newmont. It was put in production, I think, 24 years ago with a 10-year mine life, and 24 years later it still has a 10-year mine life. From a parallel in terms of width, in terms of grade, in terms of plunge, again, as close to a parallel you can get in the geological world.
Okay, and what is the sort of, say, the ore body itself? What's the sort of width and depth of this thing? When does the mineralization start, and how deep does it go?
We essentially outcrop on most of our deposits, or very near subcrop, and most of our reserves are in anticline or syncline, so fold noses. Mm-hmm. And it's not uncommon for us to see 60, 70, 80 meter widths with thicknesses of 20 plus meters. On each side of those we have limbs that are generally 4 to 5 meters thick and fairly consistent grade, although what we have shown in recent exploration is we've been very successful in delineating a much higher than average grade that we believe that we can deliver earlier to the plant, and with that hopefully flex our production profile.
And you made a comparison earlier there about another mine that was similar profile, had an extension of 10 years. I mean, is this open at depth, open along strike?
Every one of our deposits is still open down plunge. One of them is still open up strike because it was a up plunge, because it was a blind discovery. So progressive exploration will be successful in delineating more ounces. And you asked before about our resources versus reserves. We converted about 3.5 million ounces into reserves. The balance of those is we have a large number of inferred reserves that just have to be drilled off a little tighter in order to bring them into measured and indicated, which can be used in feasibilities and future production profiles.
Awesome. So obviously that's something that you, I assume, will be doing at some point, but at the moment focus is on actually getting this thing into production.
Number one focus is getting into production. But with that being said, if it hadn't been for us exploring this over the last 5 years, while we were early in the development window, we wouldn't have the project that we have today. We wouldn't have a project that we believe we can flex close to 400,000 ounces a year if we continue showing these kind of high grades near surface or in the underground reaches. And that's really why we've been pushing the underground ramp and continue with drilling, is we believe that we can deliver even a better production profile over the short to medium term.
And I just want to touch on metallurgy and recovery rates and the processing methods that you're going to be using on this mine
Sure.
as well, if you don't mind.
If you look at all the Canadian banded iron formations, they're very consistent when it comes to metallurgy and recoveries. You can float and leach your concentrates. Preferably is for deposits like this is whole ore leach. We use carbon and pulp, and 93% recoveries, about 40% of our recoveries with gravity on the front end of the plant.
Awesome. Okay, and now let's look at economics. I think this is the main thing that people are going to want. What's the sort of rate of return that we're looking at this mine? Can you talk about? I think you released a feasibility study last year.
In 2021 we released a feasibility, and that used $1,600 gold, and showed a very healthy return and a $1.2 billion after-tax net asset value at 3,000 tons per day, with an expansion to 4,000 tons per day in the end of year 2. We have disclosed and we have committed that is no longer the plan. For a variety of reasons, we're building it at 4,000 tons a day in the onset. We still haven't released the economic impact of that. It's about $10 million of additional capital, but we haven't released the impact that extra 1,000 tons a day will have over those first 21 months, which is the market.
So based on the current construction and sort of the way that you're envisioning the mine plan at the moment, what's the sort of all-in sustaining costs potentially that this?
Under that feasibility in 2021, it was $775 US all-in sustaining costs. Again, it's grade, and these high-grade deposits have certainly far less sensitivity to OPEX and capital changes. So they're really the kind of deposits you want to be building in a potential inflationary environment.
Well, as we're talking about inflationary environments, obviously you're building the projects at the moment.
Yes.
How much of the capital have you already secured? Is it fully funded? And what are the inflationary pressures that you are seeing at the moment? Is there contingency? Do you expect to go into that?
So our capital cost under feasibility was just over 600 million Canadian. This year we've raised about $807 million Canadian. We're cognizant that we are in an inflationary environment, so we wanted to make sure there was additional contingency beyond the contingency that we had in our feasibility study. We are seeing inflationary pressures, but by the nature of our project is that we do seasonal sea lifts to bring all of our equipment in a year ahead of when we need it. So if you look at the last 2 sea lifts, of which has been 80% of the equipment and material that we need to build this mine has already been procured. And so that was really procured based on 2020 and 2021 dollars, the majority of that. So it's not that we anticipated inflationary pressures like this, but because of the nature of the project, we're able to mitigate many of those because of early procurement, because of the nature of the project. And it goes beyond that, because in order to do that level of procurement ahead of time, your engineering has to be above and beyond to allow that to have that kind of specificity in the equipment and material that you need. So our detailed engineering is about 95% on the project now. So even that level of preparation, again, paramount when you're working in a remote area like we are.
And I just want to get my head around what the longer term potential is with this camp. I mean, you've got the projects at the moment that you're building. Obviously, like you said, the focus has to be to get into production and sort of get cash flow. But what sort of annual cash flow could we be looking at here?
Well, if we look at an AISC of $775 and a $1,600 gold price, that's almost $900 an ounce, and we're looking at in those first 3-4 years under the 3,000 ton a day at 340,000 ounces a year. That's a tremendous amount of cash flow. Flexing that to 4,000 tons that we do, it increases that, and at really no additional mining cost if we want to feed stockpiles. Because one of the things that we've done from an environmental perspective and a de-risk in terms of construction perspective is we're not constructing above ground tailings. What we're doing is pre-mining open pits and using those for tailing storage. It costs more up front in capital, but what it does do is all our tailings are now secured below ground. And I have a 2-year stockpile for this plant the day we turn the plant on. So it gives us tremendous flexibility in terms of blending, in terms of if there are production issues in the early days and ramp up on the mining side. So again, we're looking at many of these things through a risk lens and trying to mitigate what could potentially be problems for us in the future.
One of the things I noticed in the feasibility study was that you're using a cutoff grade around 1.4 grams per ton. What was the
on the open pits we are.
on the open pits?
Yes.
What was the idea there? I mean, could you obviously, does it become harder to process if you go any lower? I mean, it sounds like it sounds pretty high.
It is pretty high, and if we look at our unit cost per mining a ton of ore and processing a ton of ore is very high considering where we are. But because of the grades, it translates into a very low cost per ounce. So it's really a factor of economics and what it costs us to mine in that part of the world. But that's most of it. But there also gets to the point that below that you open up the resource to a lot of material that is much harder to mine and lower grade.
Okay.
So it's really a blend of all those functions.
I guess another part that, as you are going into production, ESG is sort of a massive aspect now, and I think with the tailings going underground, I think that's a massive tick in a lot of people's boxes. I mean, is there anything else that you're doing to, I guess, demonstrate that you are sort of actively sustainable and going to be doing the right thing with this mine?
Look, Nunavut has the most modern permitting act in Canada when it comes to ESG, because Nunavut was created under the Nunavut Agreement. And what they did for it, and all land claims are settled. So within the three Kitikmeot or three Inuit organizations that operate in Nunavut, they've got a seat at the table during all of the permitting process. So a lot of the things that people are talking about from an ESG perspective that they think are new and novel have been in the Nunavut mining regulations and the permitting procedures for several decades. And we are entering and working in an area that there is a landowner that we have to respect. And at the end of the day, is what we want to do is be good stewards and leave people with something more than when we came. So, jobs and training, opportunities, mining, whether we believe that this is going to be a multi-generational asset, but it is finite. So I think, the real premise of ESG is leave behind, a positive impact after you're gone.
No, absolutely. And one of the things I wanted to get my head around was looking a bit more forward. Obviously, you've got this construction going on, but what does the next couple of years look like for Sabina? How do you envision this company growing and sort of more value accretion for the shareholders? Well,
the first thing is getting us up and running, a positive cash flow. But this is a district. We've got an 80-kilometer district that we own all the prospective iron formation. All of our deposits are open. We're finding that with more geologic knowledge that we're able to better understand these deposits and consistently deliver higher grade than we have in a feasibility that we think we can discreetly mine and positively impact the economics. But we also have a satellite property 50 kilometers away called George. We opened up the camp for the first time in a decade this summer. We're going to commence exploration on that, drilling next spring, we believe. And it's really opened up a second front. So, what a lot of junior emerging producers struggle with is now that we've got the one mine, where's the second mine? Exactly, yeah. Well, we believe the second mine is already within the belt, and starting with an endowment of 2 million ounces from the onset. There's a lot of people, at Beaver Creek Conference today that wish they could get to that level. And this is, again, plus, 5.5, 6 gram material. So it is meaningful, and we believe that's the second leg of the stool.
Awesome. Bruce, thank you for your time.
Thank you very much.